In this episode from Macro Horizons, Ian Lyngen and Ben Jeffery bring you their thoughts on the U.S. rates market for the week of May 19th, 2025, and respond to questions submitted by listeners and clients.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
This is Macro Horizons, episode 324, What Recession? Presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 19th. And as investor attention shifts away from fretting over a recession to worrying about reflation, we cannot help but marvel at what a 20% bounce in the equity market can do. Stocks up, moods up. The correlation is strong, even if the R-square is a bit circumspect. In the week just past, the most relevant data event came in the form of the April core CPI print, which was up 0.237 on a month-over-month basis. This is certainly consistent with a cooling inflation environment. And we also saw the supercore come in at 0.209%, so relatively benign overall. Both rent and OER have started to drift back towards pre-pandemic levels, with rent up 0.34% and OER printing at 0.357. On net, the takeaway from the inflation profile has been one of cooling back in line with what the Fed would like to see. However, with the overhang of tariffs potentially putting in a floor for goods inflation over the summer months, it's difficult to envision that the pre-trade war data will be sufficient for the Fed to start the conversation about rate cuts again. Instead, we continue to anticipate that the Fed won't lower rates again until the September meeting at the earliest, as it will require several months' worth of data before the Fed is convinced in either direction. The week just past also included disappointing PPI figures, with April's PPI print coming in down 0.5% versus expectations for a modest increase. The retail sales report was mixed. The headline showed a small amount of growth, but the control group within the retail sales series surprised on the downside, which suggests that the pace of consumption as the second quarter gets underway might be facing some meaningful headwinds. Now, it follows intuitively that all of the uncertainty created by the swings in the equity market and Trump's approach to the trade war have weighed on consumer sentiment, and that has subsequently impacted spending. The price action in the Treasury market was somewhat at odds with what the economic data was implying. The economic data profile would have suggested flat to slightly lower yields. Instead, what we saw was a backup in rates that got 10-year yields back above 4.50, even if it was only for a brief moment. The broader sentiment being a risk-on one, as equity prices rallied back into positive territory for the year. Also reflected in the price action is an implied lower probability of a recession in 2025, now that Trump has scaled back some of the more extreme trade war rhetoric and there's been a 90-day pause put on Chinese tariffs. All of this has added to the risk-on sentiment and the broader-based optimism that began with the stronger-than-expected payrolls report seen earlier this month. The front end of the yield curve has been responding what we'll characterize as appropriately, but overdone. 2-year yields pushed back above 4%, and that did ultimately bring in some buying interest, and the front end benchmark has slipped back into 3-handle territory. It's been a marginal curve steepener, but more than anything else, it prevented further flattening from pushing 2s, 10s materially below 50 basis points.
We have April's CPI report in hand, and the market has traded it accordingly. And given the state of the macro backdrop, it was an especially telling CPI print, given that it incorporated, at least partially, the impacts of Liberation Day and represented a piece of new information that incorporates the impact of the trade war and the broader uncertainty that certainly defined last month in terms of the macro outlook and in terms of the price action in treasuries. Now, as we heard at the May FOMC, the Fed has already acknowledged that risks to both sides of the dual mandate are becoming more pronounced, and that means that the committee now sees a higher risk of a reinflationary acceleration, along with a more elevated risk of a higher unemployment rate. Said differently, the specter of stagflation is once again top of mind and has put the Fed and the market in the unenviable position of forcing to choose. Has disinflation run far enough? Is core PCE close enough to 2% that now the committee can start considering the forward risks around the path of the labor market? Or is more elevated joblessness the price that the Fed is going to have to pay to ensure that we don't see another surge in inflation and maintain the central bank's credibility as it relates to being able to keep consumer price growth under control?
The notion of stagflation in the current environment is an interesting one because we do have the external shock of the trade war and what that could mean for higher prices going forward. But at the same time, there's not the obvious path to driving nominal wages higher that we saw during the last true period of stagflation in the U.S., which was the 1970s and 80s. Recall that the stagflation period in the 70s and 80s was triggered by the oil embargoes that led to higher gasoline prices and higher realized CPI, and then union contracts, which had cost of living adjustments linked directly to headline CPI, led to higher wages for roughly 35% of the labor force that was represented by unions. Fast forward to today, collective bargaining is not as prevalent in the U.S. labor force, but perhaps more importantly, there are no longer cost of living adjustments linked directly to headline CPI. The only subset of households in the U.S. that do have COLA adjustments linked to headline CPI are retirees receiving Social Security payments, and that's not a subset of the U.S. economy that has historically been credited for driving consumption or prices. So when we think about the challenges ahead for the Fed, we're more comfortable characterizing this as a stagflation-light episode unless and until there's evidence of further tightening in the labor market. And to be fair, this is one of the major wildcards resulting from President Trump's agenda. We know that immigration reform is a line item for the administration, and as immigration has slowed since Trump's election, it will be interesting to see the degree to which this leads to scarcity for frontline service sector and low-wage, low-skilled workers. There is an argument to be made that this will put a floor in for average hourly earnings and nominal wage gains, and that's going to be an important consideration for the FOMC, especially in the event of any acceleration in core services ex OER and rent.
And in this year so far of transition, another aspect of the labor market that we've seen and is worth considering is that we may have reached the point where the broader uncertainty on the firm level has reached a pullback in investment, obviously deferred capex, maybe slower hiring or no hiring altogether, as a way to cut costs and preserve capital until there is a better picture around what raw goods might cost and around how access to different markets around the world is going to be reshaped. What we've not yet really seen is a shift from that holding pattern dynamic to full-fledged layoffs and firms of all sizes, from small to large, being forced to take more dramatic cost-cutting efforts via downsizing workforces. As is the case during any business cycle, the easiest way to cut costs is to trim labor costs, and the fact that we've not yet seen that start to play out, with jobless claims probably the timeliest update we have in that regard, is another driver of the dynamic that you touched on, Ian, which is that the Fed probably doesn't feel any great dovish pressure simply because the departure point of the labor market from the immediate post-pandemic period was so strong. An unemployment rate that starts with a 4 is hardly cause for concern or any great worry that monetary policy is too tight, and given the upside inflationary risks that are obviously still present as a function of tariffs and otherwise, this has afforded the Fed the luxury of being able to stay patient and reinforce the no rush to act mantra.
You make the observation that the Fed isn't feeling any dovish pressure outside of what is coming from the White House, of course. And as a result, monetary policymakers are in a very unique situation in terms of their ongoing effort to remain and demonstrate central banking independence. There's an argument to be made that the more vocal Trump becomes in advocating for a rate cut or a dovish stance, that the more entrenched Powell should become at avoiding such a transition. All that being said, at the end of the day, the chair is charged with the Fed's dual mandate of full employment and maintaining price stability. And as you point out, Ben, in the absence of any clear and arguably dramatic deterioration on the labor front, the importance of keeping forward inflation expectations well anchored trumps, pun intended, any near-term dovish bias.
And as was the case when we saw inflation surge coming out of COVID, the inflation expectations aspect of the trade war is just as severe a consequence as the actual realized inflationary pressures that could result from a higher import cost regime that becomes entrenched over the longer term. On a very simple basis, the way that we like to think about most things, the fact that the buzzword of 2025 has unquestionably been tariffs, expensive, higher prices, is going to have, and frankly has already had, a demonstrable impact on the break-evens market, but also survey-based measures of inflation expectations. The New York Fed's comes to mind, as does the University of Michigan's, and while in outright terms, 1- and 5- to 10-year inflation expectation surveys of the general public probably are not the best predictor of what actually comes to pass in terms of the outright number of inflation, the trajectory of those inflation expectations numbers does matter, and the fact that they are trending higher, even if the Fed is not setting monetary policy to the University of Michigan survey, is certainly a variable that's entered the Fed's equation in determining the timing and magnitude of the next rate cut.
And while it hasn't been particularly topical recently, it is important to keep in mind that we're still dealing with the debt ceiling issue, and as the debate in Congress regarding the budget continues to unfold, we're continuing to watch the extraordinary measures remain in place and the TGA be spent down. The real wild card, of course, is tax receipts. And this builds into the X date, which now we're currently estimating to be in late September or early October, which, frankly, does give Congress a fair amount of time to cobble together some type of deal and raise or suspend the debt ceiling. We're certainly sympathetic to the Fed's concerns that drove the FOMC to reduce QT in treasuries, that once the debt ceiling issue is resolved, that the process of issuing bills to replenish TGA will create a very swift drain of reserves, which in and of itself creates the possibility that we see some dislocations in the funding market. Now, we'll be the first to concede that thus far in the cycle, we have yet to see any dramatic funding dislocations. And if nothing else, that's certainly a win for Powell and certainly a win for the functioning of financial markets as a whole. But nonetheless, this should remain a consideration as we ponder the summer months and into the autumn.
Honestly, at this stage, just anything to keep Besant from hitting the ceiling.
It's not Besant that I'm worried about. In the week ahead, the Treasury market will have remarkably little economic data from which to derive trading direction. The highlight, interestingly enough, appears to be Thursday's jobless claims release. Friday is a recommended early close ahead of the Memorial Day weekend, and as a result, we expect much of the trading direction will be a function of the headlines coming out of the White House, as well as the incoming commentary from monetary policymakers. There is a full slate of Fed speakers, including voters Jefferson and Williams, that should provide some context for the reaction function of monetary policymakers as it relates to the trade war. The market is also eager for any clarity on the SLR exemption. Our operating assumption is that the exemption will more than likely come back in some way, shape, or form. However, this hasn't necessarily been the binding constraint for bank portfolios, although it should, on the margin, facilitate market making for the dealers. All of that being said, we don't think that this is an issue for nominal rates, although it could trigger another round of swap spread widening as cash outperforms. We do have a $16 billion 20-year auction on Wednesday, as well as an $18 billion 10-year TIPS auction on Thursday. But as a theme, we anticipate that the market will remain largely range-bound with a modest downward bias on yields. Now, while we are cognizant that the shape of the yield curve has largely been a directional trade, we do see scope for a more significant repricing towards lower yields in the 2-year sector, which leaves us open to a bull steepening from here. That being said, we view 450 and 10-year yields as a battleground, and anytime the market backs up materially above 450, we expect the sector will find some dip buying interest. And let us not forget the interplay between risk assets and rates. We've seen that as the equity market has continued to recover, there's been upward pressure on yields, which follows intuitively given the current risk-on, risk-off dynamic. That being said, we suspect that the recovery of risk assets can only push yields so high until higher rates in and of themselves become an issue for the equity market and we see valuations revisited. For the time being, however, and with an upper bound for 10-year rates in the 460 to 465 zone, we expect that the baseline risk-on, risk-off dynamic will persist. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the market continues to debate how regulators will weigh in on the SLR issue, we're left to ponder whether digital photography might have already seen its peak and the old school is back in style. It definitely strikes us as mission creep. Turns out, there's not even a Department of Government photography. Where did Elon go?
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.